Okay, thank you. So welcome back, and thank you for bearing with me. It's been a long 2 days, and if the Crypto Asset Lab, this is the 6th edition, so 6 years, actually 7 years because we skipped one. This is the 28th quarterly report, so I will leave to you the division. No, okay, I will help you. This is the 7th year that we are monitoring Bitcoin, crypto asset, and blockchain. The Digital Gold Institute is the Research and Development Center of CheckSig, and is specialized on consulting, research, training, and development. I've been a Bitcoiner since 2014, after 20 plus years in investment banking, finance professional, entrepreneur, university professor. BICOC has been the first university paying attention to Bitcoin in 2014, together with Stanford and Princeton. I don't know why Stanford and Princeton have a better coverage on the press. Okay. The report is structured on sections on markets, ecosystem, regulation, and technology. Markets, okay. So the performance this quarter has been disappointing, to say the least, minus 23% for Bitcoin, and overall, in terms of the all crypto assets, minus 25%. Nonetheless, this has been a very exciting year, and the trading, as you can see, it's basically at the peak of 2024, signaling sustained market engagement. And okay, after 2 consecutive years of Bitcoin being the best performing asset class, this year is not that the case. Silver and gold took the throne, but as you can see, Bitcoin is something like the best performer in the last 10 out of 13 years, something like that. And even after 23% pullback, which has basically raised the all year-to-year gains, okay, offsetting a couple of positive preceding quarter, the idea of 2025 being a negative year is something very strange, in my personal opinion, and has more to do with the unfortunate timing of December, because if the year would have ended at the end of October, the press coverage would have been completely different. Last year, Bitcoin had 4 all-time high. So I don't know how people can say that this has been a bad year. And after years of extreme volatility, drawdowns are finally toward structural correction. Yes, please do remember that Bitcoin was used to minus 93%, minus 83%, minus 22%. Instead, in 24 and 25, the drawdown have been minus 20, minus 30%. Well, not scaring at all. Bitcoin has been normalized, at least from the point of view of drawdown. Oh yes, European Central Bank, the Italian Central Bank, most regulators will tell you that crypto assets are volatile. Oh, what a discovery. Let's do this. Let's compare the volatility of Bitcoin with the Magnificent Seven. Okay, on the press, people use oftentimes 1 year of weekly log returns. Okay, that's fine. And as you can see, Bitcoin is less volatile than NVIDIA or Tesla, and slightly more volatile than Apple, Meta, Amazon, Google, or Microsoft. So it's just a regular guy. Correlations. And you know, press, even financial press, unfortunately has the bad habit of measuring correlation with 3 months of daily log returns. I studied physics, and in statistics class, no one would have a good grade if you say that you can have statistics with 90 observations, okay? 1 year of daily log return is slightly better. Even better is 3 years of weekly log returns. What you can see here is that crypto assets are hugely correlated among themselves, because this is the Bitcoin correlation in red with Ethereum, the Bitcoin Binance token, Ripple or Cardano. And in blue, you have the Nasdaq, the Standard & Poor's, gold, crude oil, and GBOX. And so as you can see, the correlation with traditional asset classes is low. Definitely very low. To make this even clearer, let's look just at Ethereum, gold, and Nasdaq. So while the correlation has been historically and this is 1 year of daily log returns. Again, interesting, but not perfect. 3 years of daily log return, 3 years of weekly log return. This is proper statistics, okay? So there's no journalists left in the house, but well, they will benefit from attending a couple of statistics class. So as you can see, the correlation between Bitcoin and Ether is substantial. The correlation of Bitcoin with gold or Nasdaq is, I will be dare to say, negligible, less than 25%. Why gold and Nasdaq? Because if you ask me, Bitcoin is the digital equivalent of gold. So its correlation with gold should be 100%. Unfortunately, the world is not really sold on that idea yet. Okay, and part of the world assimilate Bitcoin to a North American tech stocks. And so in that case, it's more like Nasdaq. But in both cases, Bitcoin is something different. It's a genuine alternative asset classes. And so even just for diversification's sake, it should be part of your investment portfolio. We can discuss if it should be 1%, 2%, 3%, 5%. But if it is 0%, I'm sorry to break the news for you, but this is just plain wrong from any point of view. The only irrational attitude toward Bitcoin is to have 0% of Bitcoin in your portfolio. Derivatives. Well, the option market is basically dominated by Unimib.It, so a non-traditional market, a not well-established market. And as you can see, the Chicago Mercantile Exchange is lagging behind. Anyway, when it comes to futures, the things are the opposite, and CME is much ahead of Unimib.It. Please note that the scale is different. This is scaling up to 400 billion. This is scaling up to 1 trillion, okay? So the futures market is definitely much larger than the option one. And these are the cumulative trading volume in non-traditional markets. As you can see, futures overshadow options, and Bitcoin and Ethereum futures are much, much bigger on the same scale of the options market, okay? The leader in the market last year, well, actually in 2024 and 2025, so in the last 2 years, has been the exchange trade funds. Okay, so as you can see in the last quarter, the Bitcoin ETF cumulative flows have been minus 1 billion, roughly. And this is basically after 2 positive quarters and 1 flat quarter, okay? And for Ethereum, there is something slightly similar, okay, but on a different scale, okay? Both scales are comparable, 65 billion, but as you can see, the Ether ETF is much less relevant. It is interesting not to really measure a correlation, but even just to plot on the same chart the Bitcoin price and ETF net flows. So as you can see, it's been the inflow in the ETF market to basically push the Bitcoin price higher and higher in the last couple of years. And the pullback of that quarter has been that one too basically dominated by ETF outflows. When it comes to Bitcoin treasury, you know, those companies, those firms that basically invest a lot of their liquidity into Bitcoin, namely Strategy and similar companies, you can see that plotting the Bitcoin price and the number of Bitcoin in treasuries, you see that even in a quarter where Bitcoin lose a lot, in terms of dollars, the amount of Bitcoin in treasury increase. This means that treasuries are smart buyer, and especially if Bitcoin decrease, they buy more, much more, to more than compensate the decreasing value of Bitcoin, so that the amount of dollars in their balance sheet has been increasing. ETFs play a huge role anyway, okay? So in terms of number of Bitcoin, they represent the 7%. Public companies like treasuries are about 5%. And then there are countries, private debt, DeFi, and mining companies. But when you read the news, please take into account that mining companies are 1/10 of ETF, and countries are 1/4, 1/3, 1/4 of ETF. So this is the relevance of the Bitcoin buyer. Let's move to the ecosystem. Okay, 2025 has been a crucial year. Yes, when you talk about the last quarter of 2025, almost inevitably you are tempted to look at the whole year. So you will indulge with me if I speak about the quarter and the last year at the same time. The National Bank, the Central Bank of the Czech Republic, is set to be investing in Bitcoin. So the governor, Mikl, has put forward a proposal to allocate up to 5% of national reserves in Bitcoin. It's been very funny when Christine Lagarde had to clarify that no Euro Central Bank will ever invest in Bitcoin. First off, she forgot to mention that the Czech Republic, it's European Union, but it's not Euro. So they can do that. And never going to invest? Oh, Christine, let's talk 10 years down the road and let's see who's right, okay? The Luxembourg Sovereign Funds has invested 1% in Bitcoin. I was in Amsterdam when the finance minister of Luxembourg announced that, and he was telling the audience about hodling Bitcoin, which was not a mistake or a typo, because between Bitcoiners, to hodl means to hold on for dear life, like you buy and never sell. And he clarified that they were investing in Bitcoin and not shitcoin. Again, his word, not mine, okay? So, I mean, not all public officials are dumb and slow like most of the European one, okay? There are even smart one. Abu Dhabi has tripled Bitcoin exposure through its sovereign funds, okay? Harvard has tripled its Bitcoin holdings, overtaking gold position. I don't know about the University of Milano Bicocca, but I mean, we might talk with the dean about what Bicocca is doing with Bitcoin. Sorry? No endowment, okay. And the crypto ETF market has expanded to Solana and Ripple, but this has basically been a failure. So let's face this again. The market is interested in Bitcoin only. Part of the market might be interested in Ethereum, slightly so. Nothing else is relevant, okay? Because regulators might be much more effective at working on what is relevant without wasting their time on the huge varieties of digital assets and trying to regulate all of them. This is a loss of time wasted. JP Morgan is set to launch loans backed by Bitcoin and Ether. These are, in the traditional finance, just Lombard loans. And in Switzerland, I can tell you that if you walk by the streets and you see sign that you can have Swiss franc loan based on your Bitcoin, providing your Bitcoin as collateral guarantees. And this is going to be a 2026 huge explosion. I can tell you that. Because of course, I mean, even if regulators are pushing for banks not to do Lombard loans backed by crypto, Bitcoin, let's remember, it's the most liquid asset worldwide. Bitcoin is traded 20 times more than Apple every day, 24 hours a day, 7 days a week, okay, Christmas included. And so it's the most liquid asset, the best collateral guarantee you can provide for Lombard loans, and this is going to explode next year. Regulation. Well, we're in Italy, and so I'm very sorry to say that Italy has increased the crypto tax regime on capital gain from 26 to 33%. This is very strange for a country and a government that have very good personal relation with Elon Musk and Donald Trump, but when it comes to crypto, seems like the relation with the Italian regulators, which are very adversarial to Bitcoin, are much more relevant. And this is a pity because Italy was the first European country to have a fully fledged tax regime and has been changing rules each and every year. Last year, in 2024, in the audition for the yearly tax law, budget law, even Bank of Italy told the government that to change rules every year was not correct. But okay, this might seem like a very local observation, but this is not, because there is a lesson to be learned. The amount of Bitcoin and crypto owned in 2025 by Italians has shrunk down much more than the minus 6% of markets, because they moved elsewhere. They moved in self-custody, they moved abroad, they moved where the fiscal monitoring of Italy is less active. So the net effect is that capitals run away. And as a matter of fact, another sign of the Italian regulator's hostility is that zero licenses have been, MiCA licenses, marketing crypto asset regulation, zero license for crypto asset service provider have been released in Italy, while we have 133 licenses granted across Europe. And we are not talking about licenses in easy jurisdictions. We're talking about licenses in Germany, France, Netherlands, okay? So basically, well, I mean, it's not a secret. Paolo Savona said that he has a personal objection and does not want to sign a license. So we all wish him a good retirement next February, because many of the Italian crypto asset service providers are waiting for his resignation in order to get our license. The Italian regulators is so lost that they're asking, along with the French one and the Austrian one, for ESMA centralization when it comes to MiCA licensing. So the world is going toward decentralization, and there are a lot of countries taking advantage of that. But part of the European countries instead, they ask for centralized and homogeneous policies. Well, I mean, this is understandable. It's much easier, as an example, to get a license in Lithuania or in Malta than it is to get it in France, Germany, or Netherlands, than it is to get it in Italy, okay? And so there should be a level playing field. Well, let's see if ESMA will take the torch and move forward. The fourth section is technology. And okay, before moving forward, there is a missing point here. It's not like we forgot about that. It's stablecoin. But I mean, we have been talking about stablecoin, and my view will not be well received if the Bank of International Settlement representative was still here. And so let's avoid about that. Stablecoin, especially because stablecoin will be the major play next year. Lombard loan on the retail front, stable year on the global sovereign front, okay? There is a play where Donald Trump, with the Genius Act, is leading the pack among governments that have understood stablecoin. I mean, even with all of these conflicts of interest, Europe is lagging behind. For the Italian native speaker, I will be talking about this next Monday on the Sole 24 Ore podcast Crypto, so stay tuned for that. there will be plenty of occasion to talk about stablecoin in 2026. When it comes to technology, the only relevant news last quarter, the last year, has been the swift integration of blockchain for 24/7 real-time payments. Okay, in order to have 24/7 real-time payments, you don't need blockchain at all. But this looks more like a very nice press release than anything substantial. I mean, let's remember that Swift is basically fighting against Ripple, which is the decentralized equivalent of Swift, or even that is not that much decentralized, but okay, so they are competing against each other. While the only relevant metric in my book is the increasing amount of hash rate being devoted to the Bitcoin network. This is on a regular scale, this is on a log scale. Here you can see in 2021 when China bunched mining, but you can see that the increase is linear on a log scale, so this is an exponential growth, okay? And this makes Bitcoin the most secure network in the world. There is no comparable financial or military network. There is no financial or military network of comparable security. Okay, so I'm done. Key quarter takeaways. Yes, Bitcoin has posted losses, yet 2025 has been an historic relevant year. Traditional finance is turning to Bitcoin as a reserve asset. Okay. And Italy's opportunity for fiscal competitiveness has been lost this year, but the hope is not lost forever. Let's work for that. 2026 will be about Lombard loans, stablecoin, and of course, Bitcoin. Okay? So see you down the road. It's very nice that the presentation of the last quarter of each and every year has been happening here at the Crypto Asset Conference, Crypto Asset Lab Conference. And basically, if some of you want to spend time now with PwC's Stefano Rossi, or with me for CheckSig, we're here. Otherwise, we're done. And let's see next year, okay? Are there any questions around that we want to answer? I think we have 5 minutes.
An investor looking at your figures at the beginning could say or could reboot that even though Google and the other tech stocks have the same risk or volatility as Bitcoin, they can be put together in a diversified portfolio, and this idiosyncratic volatility can be reduced. In case of Bitcoin, what is the portfolio? Because you show us that Bitcoin is also makes also all the volatility, all the others tokens are highly correlated to Bitcoin. So how to organize a portfolio which reduces volatility?
Well, I mean, introducing one crypto asset in your diversified portfolio increase expected returns at the same level of volatility, or decrease volatility for the same level of expected return. So it is providing a real diversification. Introducing 2 or more crypto assets is not providing any further diversification for real. I mean, in the last 3 or 4 years, there has been some diversification between Bitcoin and everything else. That's why I usually measure the correlation between Bitcoin and Ethereum. Because if you measure the correlation between Ethereum and the other crypto, it's even higher than that, okay? So a correlation which has been basically 90% pre-pandemic has gone down to 70% post-pandemic. But as you can say, 70% is still a very high correlation. So when it comes to crypto asset, to introduce them in your diversified investment portfolio is mandatory. The percentage is subjective, depends on your time horizon, on your risk appetite, and so on and so forth. Which one is just a qualitative decision, because there is no real diversification among them. That's why the market preferred Bitcoin, because it's the most established, the older, the best working one, with someone leaning toward Ethereum, basically for its more advanced features that are still to be proved really useful anyway. Yes, Stefano?
I would like to know your comments about the paper we saw today on the infinite money glitch. What's your take on companies like Strategy doing this, no pun intended, strategy on Bitcoin buying by using debt?
Well, I mean, my marketing department usually try to stop me from being too clear and forthcoming about the issue, but they fail and they're not here. So the same way as I've been disappointed by the speech this morning of Bank of International Settlement that deemed stablecoin as unreliable, while they are more reliable than banks, okay, because they are not fractional reserve. At the same time, I have to say that when equity indices like MSCI say that strategy does not belong to an equity index, I agree with that. I mean, its strategy is basically these days like an ETF in Bitcoin. Nonetheless, even if they should not belong to equity indices, which will reduce their traction, because the funny thing is that these days the Central Bank of Norway or the Central Bank of Switzerland, they had to buy strategy in order to replicate the equity indexes. And so they have exposure to Bitcoin. Indirect, but they have exposure to Bitcoin. So we have already central banks with indirect exposure to Bitcoin. So removing strategy from the NASDAQ, as an example, will lower its pervasiveness in the financial market, and this is due. It has to be understood that what Michael Saylor has been doing is smart. I mean, he has provided through strategy a way of buying, selling, holding Bitcoin for those who were not entitled to. Okay, if you are a bond manager, you cannot buy Bitcoin bond, but you can buy bond issued by strategy. If you are an equity manager, you cannot buy Bitcoin equity, but you can buy strategy. If you are a derivative traders which cannot do derivatives on Bitcoin, you can do derivatives on strategy. And so basically, they have been exploiting the some nonsensical limits put on by regulators, and have allowed smarter use or integration of Bitcoin into different strategies. And that has been paid off very well for strategy. Of course, strategy has been a bubble, because when its equity value was 60% of the MNAV, so of the value of Bitcoin, that was completely out of the world. But currently at 1.1 times the MNAV, that is pretty much sound and safe, because it's the extra value of that flexibility. If regulators will just allow the use of Bitcoin on different venues for different players more freely, this kind of market dislocation will not happen. Two more questions.
Thank you. I have a couple of questions. The first one is about stablecoins. There is almost a monopoly or duopoly on that. Which is your feeling in the future and in this year and the next year? So there will be the evolution of some alternative stablecoin. And second question, also in the Eurozone, of course, And the second question is, okay, it's quite disappointing from the point of view of someone who takes seriously the crypto market to see the Far West in the, I would employ a politically correct term, in the altcoins Far West. So, which is your feeling here also? Do you think that there will be some mandatory regulation that will get rid of this list of very strange, I don't mention meme coins, but at least, I mean, the very long list of Far West? Which is your feeling?
Okay, shitcoin has been used in the US Senate, so now it's officially something that you can say in a way. Let's start from the altcoin. One of the reasons altcoin has been so popular in the previous years, I will not say that they are relevant, have been relevant in 2025 at all. It's again a regulator's fault. When the European Banking Authority told central banks, the European central banks, to stop the European financial institution from buying, selling, and holding what at the time was named virtual currencies, and that was a warning issued in July 2014, more than 11 years ago, more than 10 years ago, more than 11 years ago. And the market in crypto asset regulation just arrived in 2024, 10 years later. So this has allowed, this has prevented regular people from just buying from their bank or financial institution. And so they went to shady intermediaries which have been exploiting the role, providing a lot of exposure to this nonsensical digital asset, okay? If they would have been able to call up their bank and ask, okay, I would love to invest 20,000 euro in Bitcoin, okay, that's fine. I would also love to invest 20,000 euro in Dogecoin. Maybe their bank will just respond, will just answer, oh, sorry, we don't cover that one. It's not good enough for us. Maybe they would have realized that those were shitcoin and would have not seen such a Far West, as you said. Stablecoin next year. Well, let me clean up my crystal ball. And what I see is that digital euro, no way. No way. The strategy of European Central Bank is confused, is mixed up. They do not understand what they're doing. I personally presented to the ECB board an implementation of digital euro in November 2017, when I was still working in Intesa Sanpaolo, and Benoit Coiré of the digital board of ECB at the time said that there was unneeded, unnecessary, and dangerous. Why was that the case? Because that was digital cash, and so was freely exchangeable through non-KYC'd counterparties, like with cash. Okay, if you pay with cash in a restaurant, it's not like anybody's going to identify you, or you have to identify the owner of the restaurant. And that is the reason of the success of Tether. Tether has KYC and AML facilities only at off-ramping and on-ramping. But in the middle, you can transact with anyone without KYC. Even when people talk about crypto crime and Bitcoin is zero. Crypto crime and Tether is 100%. Okay? And as we have seen with the Genius Act and the Trump administration support of stablecoin, it's like the usual with the United States. They close an eyes, even both eyes, on criminal activities if it is in their favor. Okay? European, we are much more serious, so we will never allow that, which means that we will never be able to issue an interesting stable coin that is relevant. I mean, these days, we can have contactless payment with Google phone, Apple phone. Why should we need stable coin? Stable coin with KYC will be just an equivalent, if not subpar, implementation. Go figure. if the implementation is provided by European Central Bank. Moreover, the European Central Bank will want the banks, the commercial banks, to implement the infrastructure. So retail banks are against the digital euro because they will have to implement an infrastructure which will be a cost for them, which will have the effect of reducing their revenues on intermediation and payments. So nonsensical at all. It's much more relevant, the strategy laid down by Donald Trump, even if that strategy originates basically from a conflict of interest of him and his family. Anyway, he said that there will be no US digital dollar issued by the Federal Reserve. And you know why? Because the Federal Reserve can bake that digital dollar without any other guarantees. Instead, private issuers, they are forced to buy treasuries, US treasuries. And so private stablecoin are crucial in the sustainability of the US public debt. As long as the cultural attitude of the European regulators is being against private stablecoin, as it is clear in MiCA, Marketing Crypto Asset Regulation, we will not see private stablecoin and a ECB-baked stablecoin is basically doomed. Why is MiCA for stopping privately issued stablecoin? Well, I mean, it's just a matter of observing things, not a matter of thinking about them. Tether has no MiCA license, so the biggest stablecoin issuer is elected not to be available in Europe. And why is that? Well, even if, I mean, I despise Tether and its founders a lot for criminal activities they have been doing in the past, this time they are perfectly right. They say to European Central Bank, we don't want to keep our collateral reserves in European banks, which can go bankrupt. We would love to keep reserves in European government notes and bonds. But this is forbidden by MiCA. And so basically a private stablecoin issued in Europe is doomed as unreliable and irrelevant. Of course, as it comes with this kind of technology, there is always the permissionless attitude of doing something that does not need to be regulated and can maybe achieve that. And I think that we will see something about that in 2026, even in Europe. The next question was, okay.
Hi, Ferdinando. I want more detail. When you said that in the future, Bitcoin will be used as collateral for lending activities a lot, okay? But in my opinion, we have using this kind of asset as a collateral a huge amount of volatility and margin risk. Why you don't see a competitor from the side of stable coins on this topic of lending collateral?
Because long-time Bitcoin investors do not want to sell Bitcoin in order to buy their houses and cars or goods and services. They prefer to pay maybe even high interest rate, like 8%, 9%, as we see in the Swiss market, because they are avoiding taxes on capital gain in location like Italy, which will already cut 33% of your crypto holdings. So you can skip capital gain taxes. And yes, you're going to pay maybe 6, 7, 8%, 12% in Italy. But if Bitcoin achieve 154% increase as it did in 2024, you're much better off with this. Especially okay. In terms of the digital estate planning, when, I don't know if you're aware, but you and I were gonna die. Not soon, but it's going to happen, okay? So when I die, my children can inherit the Bitcoin at the reference price of my day of death and sterilize any kind of capital gain. So maybe when I will be older, I'm much better off not selling Bitcoin, but just borrowing against my Bitcoins. And this is not in the future. This is already happening in Switzerland a lot. And when you say that, when you see JP Morgan moving, you know that this is going to happen. In CheckSig, we have 180 million in custody. And I can tell you that roughly probably 20-25% of those Bitcoins will immediately subscribe a loan for using those Bitcoin as collateral. And if you're worried about volatility, you should be not. Because you can use Tesla, Amazon, or Apple as collateral, equities, I mean. So Bitcoin is no different. And I can tell you...
It's not typical to use Tesla.
Yeah, but I can tell you that we have seen as CheckSig, we do escrow holder. So we are the custodian for private agreements between lender and borrowers. And we have observed last year 13 operations, 13 deals, with interest rate ranging from 8% up to 12%, but loan to value ratio of 50% up to 20%. 20% loan to debt ratio means that the guarantees, the collateral is 5 times the amount being lended or borrowed, okay? So, and no deal, of course, at less than 200% of collateral guarantee. So if you are going to over-collateralize, that's perfectly fine and sustainable. Add to this that Bitcoin is trading 24 hours, 7 days a week. So you have no close gap. It's not like you go to bed and at the opening in the morning, your collateral has lost overnight 10%. No, because that is a continuous trading. And so you can monitor, you can issue margin call, you can liquidate in automatic. And so it's much, much safer, provided that the collateralization, of course, is relevant. Okay?
Okay, thank you.
I think we're done. 4 minutes ahead of the time. And thank you very much for your attention. And if you have a question for PwC now or for me, we are here. Otherwise, see you next year. Bye.